Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. Quick look at the global markets first, where the Wall Street posted a solid weekly advance in the previous one. The S&P 500 and Dow rose 1.2% and 1% respectively. For the week, the tech-heavy Nasdaq is jumped 2.2% as well. The Asian markets, in the meanwhile, are trading mixed. The Chinese central bank has kept the loan priming rate unchanged for the fourth month in a row. Back home, the Nifty is trading with a flat to a negative bias above those 25,300 kind of levels. Take a look at the crude oil prices in the meanwhile, and we have seen them holding in the green as worries about large supplies and declining demand outweighed expectations that the year's first interest rate cut by the US Federal Reserve would trigger more consumption. The street also continues to monitor brewing geopolitical tensions in Europe and West Asia. We already have seen 2 weeks of gains in the crude oil prices, and this clearly is the third week starting on a positive note. There you have the dollar index, which is holding steady around those 97 levels, extending the post-FOMC rebound. Now, what's left to watch in this week is whether the US currency has room to rebound further. Carole Nakhle is Chief Executive Officer at Crystol Energy and joins us with sense on what really has to be seen in case of the energy markets there. Carole, hi, good to have you. First of all, the 19th package that the European Union has come out with in sanctions for Russia is something that the street is watching out for. And that bit of a gain that we're looking at in the markets perhaps comes in from that, because now we have LNG as a part of the sanctions. The European Union says that from 1st of January 2027, they would stop importing that from Russia. How are you reading this sanction overall?
Hello from London. So first of all, let's dissect a little bit oil markets and gas markets when it comes to Europe. But there is no doubt that in both cases, we see a significant impact of geopolitics on this kind of movement in prices, in spot prices. Now, this is why we have to be careful and not to rush to conclusion, because if the market is reacting so closely to these kind of news without seeing an impact on the structural fundamental of the market, that is supply and demand, then these kind of movements are going to be a little bit rather meaningful in terms of the direction of the market. So it's only if those geopolitical developments, including the sanctions that you referred to, result in a meaningful disruption to supply, then we're going to see more lasting impact on prices. Otherwise, we'll continue to see this a bit of prices going up depending on the news, or going down depending if those news become a little bit more relaxed. Now, to go back to the question of sanctions, there's no doubt that Western powers, primarily the European Union and the UK, as well, and the US and other allies when it comes to the position of Western powers against Russia, there is no doubt there is an escalation in terms of tightening the screws on Russia to reduce the revenues that Russia is generating from its sale of oil and gas, because those revenues are what is keeping the Russian economy largely going. It's a war economy, and oil and gas revenues continue to fuel it. Whether they will succeed or not, it depends on the enforcement of the sanctions, because so far we saw with oil sanctions, they resulted in simply in redirection of the trade flow. We did not lose supply from the market. Now, if the Americans, on top of the Europeans, tighten the sanctions and they make them, harder to evade, and also they impose more stringent secondary sanctions, i.e. on the buyers of the Russian oil, including India and China, which are both very important buyers of Russian oil, then we are likely to see more lasting impact on oil and gas markets. But at this stage, we are hearing of threats, we are hearing of announcements, but we are yet to see how would those translate into actual disruptions in the market.
Carole, also comment on the latest storm brewing now with the Atlantic. That's another thing that we start watching out for, don't we, when it comes to September and October. Gabrielle, a second hurricane, that's something that the market has eyes on. With the kind of excess supplies that we already have and demand concerns as well, would you say that this season perhaps wouldn't make much of an impact on markets?
I mean, look, markets are pretty clever in terms of understanding that there are certain periods where we could expect certain disruptions. So if you have, as you mentioned, the hurricane season, that's definitely something we keep an eye on. So we keep on watching the weather in key areas, particularly in the Gulf of Mexico. But they will not change the overall direction of the market. So when I look at prices, yes, we saw maybe recently with the geopolitical developments a little bit of upward pressure on prices, but in oil markets, for instance, the Fed cutting rates, people will translate that into perhaps boosting demand a little bit. But on balance, when I see where prices are today compared to where they were, let's say, in previous years when there were such or something similar on the geopolitical front, I already get the main message that there is too much supply chasing too little demand. So demand is growing, but not at the same speed as supply. So imagine that you have a race, yeah, and it all depends on who is growing faster, who is going faster. In this case, we see the supply from within OPEC Plus because they released barrels in the market, and from outside OPEC Plus, led by the US, but also from Norway, Guyana, Brazil, Canada, etc. I'm not to name but a few. So we see a healthy growth supply, which is outweighing the growth in demand. And this is what we have in terms of prices. So yes, if there are some disruptions because of hurricanes, that might support prices, but it's not going to have, again, a lasting impact. It seems that currently the direction of the market is clear, subject to some significant developments that can result in supply disruptions. But I don't think we should expect the demand to suddenly boom overnight, like flickering a switch, and that's it. We're going to have a massive influx of demand on oil because there are fundamental economic problems, especially in the second largest economy in the world, that is China, that need to be tackled first.
Carole, and that in the line of what you said then, what is your sense on where the crude prices are headed? Because we started this year with 75. We almost went to 80 plus kind of levels. We've seen a low of $60 on Brent as well. We are trading at 67 right now. So it has been a volatile year, but we continue to hold below 70. How are you looking at the last quarter of this year? And what's your sense for a slightly longer period also?
If there are no supply disruptions because of geopolitical developments, and we're really living in a very uncertain world with the geopolitical tensions rising in key regions around the world, whether consuming regions or producing regions such as the Middle East. So if we just see like what we have seen in the last few months, just threats, but no supply disruptions, and under existing economic forecast when it comes to global economic growth, especially also economic growth in key markets, key economies, I don't think we should expect prices to change direction in the last quarter of this year. The market is telling us that the market is well supplied. There is sufficient spare capacity in OPEC. Yes, it is it's declining because OPEC Plus is releasing more barrels in the market, but still that leaves us with sufficient spare capacity to compensate for an average, let's say, geopolitical development. So if I put all these in the blender, I say that we should not expect the picture on oil prices to change dramatically but towards the end of this year. If anything, if I look also at the forecast for next year, I'm not seeing much changes as well in the picture.
When you say that, would you want to put price levels to that as well? I mean, are you looking at 60? Are you looking at 70? Are you looking at sub 60? Because there are all those kind of levels being thrown around.
You know how to put me on the spot. And as an economist, I believe that we're much better at forecasting the weather than the oil price. So I would refrain from giving you a figure because I'm sure I will be proven wrong tomorrow. But let's say the direction of the market is going to be more or less the same. So the range bound that we have seen, mid 60s to high 60s or low 70s, this is a kind of consensus that you currently have in the market. So I would leave it there and don't squeeze me more because I will not give you a specific answer because I know I'll be wrong.
All right, Carole, I like what you said. It's easier to do weather rather than crude prices. Well, yes, it has been very, very volatile to that effect. Coming on the LNG prices then, and with all this sanction conversation, well, yes, it has seen a knee-jerk reaction come in for the prices. But with the way the LNG demand is expected to increase, even for the Indian markets, the mix is on the higher side. How are you looking at the global LNG demand? And what's your sense on move in the sense of direction on prices here?
Yeah, so to clarify here, when we talk about LNG prices, we're not talking about oil gas prices because we don't yet have a global market like we have with oil. So we still have a big chunk of gas traded through pipeline, and there is also a notable chunk of LNG still traded under long-term contracts with fixed prices indexed to oil, especially in Asia. But what I can tell you, if we're talking about this volatility or changes in spot prices, we're going to look at the chunk of or the portion of LNG traded on the spot market. And this is where we look at market dynamics. Now, yes, we have the decision of the EU to maybe accelerate phasing out all imports of gas coming from Russia. But at the same time, this has coincided. I mean, of course, it's not like a coincidence, but was engineered around the trade talks and the trade deal that was announced between the US and the European Union in August or in July, so over the summer. And if you look at the trade deal, which resulted in much lower tariffs than what was originally threatened to be the rate, the big chunk was energy and particularly LNG, whereby the US will supply Europe with a big share of LNG. They are already the largest supplier of LNG, but that means that the European Union was going to spend almost $250 billion a year over the next 3 years on purchasing energy, primarily gas from the US in the form of LNG. Now, when you look at the numbers compared to where we are today, this definitely means that, of course, if the US can increase capacity, that the European market is going to be well supplied. What that means for other regions, it depends again on many factors that can affect demand for gas. But if all US LNG or most of it will be diverted to Europe, this raises a question in terms of who will fill the gap in Asia. The Russians have announced a big pipeline deal with China, but does not go to bring the gas immediately. So Russia does not have immediate option to divert all of its gas elsewhere. The Middle Eastern countries, they have healthy supplies, Qatar in particular, but they are already mostly tied to contract. So depending on the market dynamics in Europe and in Asia, we could see some tightening of the supplies in Asia, but that is subject to demand growth and weather condition and supply of other fuels, because gas, unlike oil, competes with every fuel in each of its applications. So it's a bit of a different animal.
And Carole, finally, coming on also on the tariff part of it, because in India, which is one of the largest growing consumers of crude imports here, is facing 25% of penalty, 50% of tariffs in all. There are conversations still on with hopes that we perhaps can see these numbers coming in lower. What is your sense, though? Because the Russian crude oil, as we've seen since the time of war, which is almost 3.5 years now, has found its way into the global markets, tariffs or no tariffs. How are you looking at the scenario playing out?
Yeah, it's a bit like I understand India's position in a sense that any consumers would like to get the best deal, right? So, and here for the Indian consumers, the best deal is getting cheap oil, discounted oil from Russia that nobody else wants it. And then you use domestically or you refine and you sell it and you make a good profit by selling it to markets such as the European Union. But at the same time, there are the political objectives that need to be achieved by, especially by Western powers, in order to accelerate the end of the war in Ukraine. And this is where the tariffs are being used as a way to impose secondary sanctions on the buyers of Russian oil. And that is primarily India, which if you look compared to China, because China is an important buyer, but it did not ramp up at the same level its oil purchases from Russia as India has done. So that is a key difference between India and China, perhaps put India more in the spotlight. The Americans already have threatened and have enacted some tariffs on India as a punishment for buying Russian oil. And they are also putting pressure on the European Union to reciprocate. And when you see this kind of pressure being added on the Indian consumers in terms of exporters, in terms of sanctions and in terms of tariffs, but they are rather secondary sanctions, then at some point it does not become economic to buy discounted Russian oil, because whatever benefit you're getting from there is being diluted by the additional tariffs imposed by other countries. So let's see if diplomatic negotiations will help to resolve this stalemate, this diplomatic mini crisis, I would say, but it has major economic impact. But it's a question of balancing the political aims, which are noble global by themselves, and the economic aims, which are the benefits of the Indian consumers.
Point taken, and we really hope those things really diffuse going forward there. As always, thank you so much, Carole, for joining in and with your sense on what really can be seen for the crude oil prices going forward. But with that, it's time now for a short breather. Up next, we will speak with Sudhakar Desai of Emami Agrotech. Stay tuned. Sudhakar Desai now joins us, who's the CEO at Emami Agrotech, and he's also the president of the IVPA. He joins us now. Mr. Desai, hi, thank you so much for joining in. And let's start with the edible oil space, first of all. And India imports more than 60% of its requirements from the global markets of edible oils. How are you reading and what do you see within the global markets between tariffs, countries mandating biofuels as the future of edible oil as a whole? So it's really between food and fuel, and then the markets also are looking at the higher imports that country continues to see.
Yes, global market, the turbulence and the volatility is the new norm. Okay. Like you rightly said, food demand is more or less set. To me, it looks like it is somewhat consolidated and more stable. But it's the biofuel and biodiesel which constitute 25% of global production. Like, for example, whether Indonesia would choose to stay put at B40 or 45 or B50 makes the palm market and its relative spread with the global markets. USA, the news about not only about the global tariff implications, but specifically in edible oil, their own mandates and the applicability of the same to the local small scale biofuel industry. These changes also cause a lot of volatility in Chicago Board of Trade, which is governed by the US dynamics. We are seeing it every day. But otherwise, overall domestic crops, whether we talk about soya crops, sunseed, palm, canola, I think more or less are in a comfortable situation. Only sunseed is a question mark as the crop is evolving still. Whether it will be same as last year, which was 4 million down, or whether it will be better than that, time will tell. But on the supply side, there is a good amount of ample supplies right now, globally speaking. We just have to see the evolution of it. India plays a very, very important role in this complex because the only home for the excess oil, either for the US soybeans or from sunseed, for example, for major crops, including palm, the destination is India. So it is very, very important to see what is happening in India, import dynamics, and thereby this import composition has undergone a massive change. In the year October to now, August itself, and even if I extrapolate September, palm imports were about 7 million as against 9 million tons, which is a whopping 2 million tons drop in palm oil itself. Soybean is increased by 1.5 million tons into India, which is a whopping 3.5 million has become 5 million. And sunseed, which was 3.8 October to September 25, 3.8 has become 2.7, which is down 1.1. So a major shift has happened in India without our realization. The import composition has completely changed the Indian consumption as well as its implication on the global markets.
Oh, well, as you said, soybean is on a high here, but also talk to us about a lot of emphasis in the Indian demand itself. The change, as you mentioned, is one part of it. But given the kind of number that India sees in sense of demand and that all of this duty impact, would you say that we do impact the global prices also?
It partially it does affect, definitely in case of palm and in case of especially for soybean oil. The Indian duty factor actually is very, very important for the global market. The absolute price table of it. Um, uh, and currently, I think everything is well supply chain has been well maintained into India. There is ample supplies. August import numbers are an indication with a whopping 16 lakh tons. It is making up for low imports of the previous time. So overall, when I see India consumption is more or less stagnant, probably due to prices or due to the risk factors emanating from the industry like Nepal imports or uncertainty about the biofuel policy, the trade has been operating on a just-in-time stocks, as indicated by a very poor Diwali demand right now. So when we look at the duty change or duty aspects of India, with the recent data of government has shown about a 20% increase in inflation of edible oils, while very luckily food inflation is negative or break even. So there is no reason for any duty changes or increases right now.
Mrs. Desai, come in also on the cheap imports part, because on one side, India is looking at self-sufficiency, while on the other side, we're also trading below MSP. And then some of our crops have seen prices decline quite sharply. We're looking at cheaper imports on the other side. With all these three happening at the same time, how would you define India's edible oil sector?
Yes, that is the key critical question in front of the sector. Although I would start by saying, apart from the duty factor, there are many other implementation aspects. There is a GM issue. There is a oilseed mission implementation issue. There is a oil palm development follow up on the execution. But if we have to talk about the duties alone, today I think the consumer is still having a little bit high prices compared to previous, if that is any benchmark. If the low demand, festival demand, retail offtake right now is an indication, I think there is a definitely not so much in Horeca, but in household there is a little bit of a cut back from the import numbers and domestic numbers and the consumption numbers that I mentioned. Rapeseed is much above MSP, as you know. It is operating already much above MSP. Hopefully, we should have a good rapeseed crop to make up. The plantings will be done in November, December. High prices of rapeseed should definitely attract more growth of rapeseed, at least I hope. Then the other major crops, the groundnut, and they're all having a static growth. When it comes to soybean, I think it is not an oil duty subject. It is a meal and DOC subject. That's the reason why the I mentioned about circularity of impacts. So we have got a very good impetus in ethanol policy, which has actually made DDGS and rice DDGS, which is the byproduct of ethanol, cheap enough, which is competing with soy meal. So in case we need to defend, which I think we should defend, the soybean MSPs, we need to take up the soy DOC competing byproduct by way of taxing in a manner that we achieve an equilibrium between the soybean, what is the farm gate prices that we want, and what is the MSP that we should want. The the acreage shift has happened actually. The Kharif numbers that we normally see, the soybean acreage has gone down and it has given way to corn actually. So there is about 6% of drop in soybean acreage. So hopefully, post by November, we will get clarity on domestic crops, the rapeseed crops, the crop evolution of soybeans, and the sunseed crop globally, which is going to harvest by September. I think we will get more clarity actually by November, December.
All right. You spoke about the MSP, and coming on that again, because MSP, we may see an increase yet again on that in the coming season also. Are you looking that as a constant price rise for the Indian markets? I mean, that really seems to be the biggest mean things now.
There is only one solution, Manisha ji, that is the dynamic duty policy that we advocate as IVPA. Number one, you know the global markets which are volatile, which means you need to respond faster than before. You on one side you have an MSP, and on the other side you have MRP. I call it, that is the price at which you want the consuming inflation, edible oil inflation to be. So matching that, we need a constant kind of a more transparent, more thought out proactive trigger mechanism in terms of giving this impetus. But when we look at the MSP situation today, at the current global prices the way they are, I think we need to take care only of the soybean crop. Otherwise, all other crops would continue to have a robust demand at MSP level. Market will do the job, especially when imports are down and stagnant last 4 years. Not only the numbers that I've said, but the imports have been stagnant. So, which is actually a good sign to give more impetus to the domestic crops. So we have to focus on all these areas basically.
Let's also talk about the Indian festival demand. You already said that the demand for Diwali seems slightly weaker as of now, but what is it that you're hearing from various FMCG companies? What is your sense now on the urban-rural divide when it comes to demand? And are you looking at demand getting better as we move ahead from here?
I don't think. I think the industry is disappointed with the demand right now. What has happened is that till July, the markets were operating at a very thin pipeline. Then it got somewhat filled up. But current month is anticipated demand. Whether you talk about Eastern Durga Puja demand, which is now almost ending in terms of timing of it, and Diwali being only 1 week left for filling the pipeline, for replenishing the pipeline, I would say. So far, the symptoms are very poor. I think something is holding back. The retail offtake definitely is very low. On the other side, the GST changes have nothing to do with much with edible oil, because the GST reduction has happened elsewhere in many commodities. I think the market is trying to adjust to those changes for another week or so. So definitely consumption should go up. How much of it will show up in edible oil will happen soon. Maybe we will not see pre-Diwali demand, my anticipation. But post Diwali, the pipeline would be so dry that the sales would pick up. So eventually, the way I see the demand has to come up. Whether it will come up, whether it will come out of the existing inventories in the pipeline, or the new demand will come. I think markets are waiting for a price at which replenishment of stocks to be done. But at the moment, if you ask me, this Diwali demand for edible oil has been very poor.
I have one final question, and this one is on prices. What is your outlook here? Because it has been quite volatile for the global markets. How are you looking at the price moves, and what really would you say would impact prices from here?
I think barring any major issues, geopolitical tensions, or a major reversal of biofuel or biodiesel policies, I would expect a very stable and consolidated market. There is not much significant reasons why the market should go down. It will stay put. The reasons are very clear. I think palm has done its job. It is more inward looking in terms of biofuel demand. Soybean, a lot of Brazilian crop has gone to China. So it is only in the US that we have got a soybean pressure, but that is so much linked to the meal demand and not oil demand. So soybean oil prices, coupled with the slow crushing, are expected to be stable. Sunseed needs marketing. It is priced right now much higher than bean oil. I think probably sun oil will lose its premiumness to soya. When I said import numbers of India, I think the major drop has happened in palm and sun. So if at all, the palm will continue to on and off becoming cheaper versus soft oils whenever it needs demand. Most of the destinations are well covered, including China, it does seem. So I don't see any major volatility unless it comes out of a policy in biodiesel.
All right, that point is well taken, Mr. Desai. Thank you so much for joining in. So clearly, it is going to be about the global markets, the currency, and of course, the biofuel mandates of various countries that can impact the edible oil prices going forward. But with that, it's all the time that we have on the show. Thank you for watching.